Yo, what's up you guys? Welcome back to another video, and for this video I do want to show you guys how to use the Fibonacci tool, because a lot of people asked me about the Fibonacci. What does the levels of the Fibonacci mean, and how you can use it to set a take profit level as well. Now, without any further ado, let's get straight into that as well. Now, for those of you that don't know, this is what the Fibonacci looks like. The one I use, you can obviously copy the settings that I have there for you. You can just copy that if you would like to, but this is the Fibonacci levels in the market. Now, the Fibonacci is obviously used to, I don't want to say predict, but it's used to forecast a retracement in the market or a pullback in the market, and also to forecast the next impulse in the market. Now, firstly, an impulse is when the market breaks structure to the upside or to the downside. This move here, this break above resistance here, this is considered an impulse, right? So we use the Fibonacci's levels here at the bottom to determine where the next impulse is going to take place, and in order to determine the pullback, we use these levels in the market, which is why it's called a Fibonacci retracement levels. Get it? Fibonacci retracement, right? Fibonacci retracement. Now, how do you use the Fibonacci levels, right? Now, the first thing that we need to understand firstly is, what does these levels mean? Now, the minus 27 or the minus 272, this is always used as the take profit 1 level, and this is used as the take profit 2 level in the market. Because remember, as traders, we always trade the impulsive moves. Sometimes people trade the corrections as well, but most traders normally trade the impulse, the next impulse, right? And then when there's a correction, it's normally considered to be profit taking, either to the upside or to the downside as well. Now, this is considered, like I said, the TP1, and this is considered the TP2 level in the market. Now we get this over here, the 0.786 is the last Fibonacci, the 61.8, which is considered a golden ratio for traders, where if the market hits that level, there's a high possibility that the market's going to pull back. We have the 0.50, that is a 50% retracement, and then we have the 0.382, a rejection of that level tells us that the market momentum is very strong. Now, let me give you an example. Now, you know it, I know it, some of the people that's supposed to know how to trade, they know it as well, right? Now, we clearly know the market moves in waves, right? The market makes an impulse, a correction, an impulse, a correction, and the market also does this move the same way to the downside, where it prints an impulse, a correction, impulse, correction, and this is basically just how the market breaks and pull back to structure, where you break above resistance, pull back, tested as support, break above resistance, pull back, tested as support, break support, tested it, testing it here as resistance there as well, right? Now, in order for us to basically measure these retracements in the market, what we need to do is we use the Fibonacci tool. Now, let's assume the market is printing an impulse to the upside, right? Now, in order to determine this retracement, right, we use the Fibonacci to give us an indication of how far the market can potentially pull back to. Now, how would you know where the market's going to pull back to? Well, it's very simple. You take your Fibonacci from the low to the high of the impulse, right? Now, when the market then starts retracing, what you do want to look for is the level which is lining up perfectly with any structure to the left of you. So if you do that, you want to see, does the 78.6 line up with any structure here? No. Does the 61.8 line up with any structure? Yes, it lines up perfectly with the previous level of resistance that is now acting as a level of support. So this will be the highest possible level that you could potentially expect the market to pull back before it continues further. Now, that is why I say these are considered retracement levels, because it's used to measure a retracement in the market. Now let's assume the market pulled back and the market came and hit the 61.8 level at this market, right? Now you want to determine where the market is going to go to next. Now the way you do this is you also take your Fibonacci, you take it from the low to the high of the correction, right? Now this level over here, like I've said before, is where the first take profit level would be, and this is basically where we would consider the market to move next. Now if you want to measure the correction again, you take the Fibonacci from the low to the high. Now, let me give you a little tip. If the market is in a bullish continuation like the one that we see over here, it's always very important that when you do measure this impulse, what you want to look for is this 38.2 to line up perfectly with the previous structure, or even if it's that structure, and that will kind of giving you an indication. Sometimes the market might be there, so it hasn't reached the structure yet, so you can definitely expect the market to continue higher until at least the 0.382 is lining up perfectly with that structure, and you can use that as an indication to determine how far the market is going to go higher to once again. Now that is basically the simplified version of how you use it. Remember, to measure a correction in the market, you take your Fibonacci from the low to the high of this impulse. In order to measure the correction in the market, what you do is, sorry, let me just restart that again because I think I'm stumbling over my own words. Okay, so in order to measure this correction in the market, you take your Fibonacci from the low to the high of this impulse. You check which Fibonacci is lining up perfectly with the structure in the market, and that's where the market's more likely to pull back to. Remember, these are retracement levels. That's why we take the Fibonacci from the low to the high to measure this retracement, right? Now, how do we measure the next impulse in the market? It's very simple. Take your Fibonacci from the low to the high of the correction. To give you a nice tip, all you basically do is, after you've measured the correction by taking the Fibonacci from the low to the high of the impulse, simply, once the market starts to take off, simply take the Fibonacci from the low, from that low onto the low of the correction, and that will also give you your take profit 1 level. Now the best thing about the take profit 1 level is when you look left on it, you will always see it lining up perfectly with structure as well. So that is a very good key indication that you can use in the market. Remember that a impulse is created after the market had created and broke above structure. This is considered an impulse because the market broke above multiple structures. This is considered an impulse because the market broke below support. This is considered an impulse. The market broke below support. And the minute the market starts breaking above resistance, we call that an impulse. And to measure that correction, we take the Fibonacci from the low to the high, and we look left to see which Fibonacci level is lining up perfectly with the structure in the market. Now, some people might argue that you can use this as a strategy. I don't think you can use it as a strategy, but we do use it as a confluence to understand more or less where the markets will more likely to pull back to before the next impulse. Guys, that is it from my side. Thank you for your time, and as always, cheers for ears.